Welcome to this explainer. Look, today we're cutting straight through the daily market noise to bring you a clear, highly actionable roadmap for your portfolio. We're basing this entirely on a really crucial August 2026 institutional market briefing. We are looking directly at a massive, structural collision between macroeconomic policy, artificial intelligence infrastructure, and global trade. And honestly, understanding exactly how this intersection is going to play out before it actually happens is absolutely vital for anyone with capital in the market right now. Because we are literally standing on the precipice of a perfectly brewing storm heading into the fourth quarter. Now, this isn't just your standard seasonal market turbulence. What this briefing outlines are massive, overlapping financial forces that are reshaping the economic landscape in real time. We're moving way past an environment where a single headline drives the day, and we're entering a phase where multiple tectonic market shifts are layering right on top of one another. Which brings us to the multi-trillion-dollar question we have to answer today. Is this unstoppable AI bull market about to violently collide with a massive macroeconomic brick wall? And, more importantly for us, how do you navigate and actually survive this impending market collision? Because getting caught off guard here isn't just about missing out on a rally. We're talking about significant structural risk to your core holdings.
So let's break down the four converging catalysts driving this entire Q4 trajectory. Think of these as the four massive engines dictating where capital is going to flow. We've got the tech litmus test, which is centered heavily around Nvidia. We've got the macro anchor dictated by the Federal Reserve. We have the surging bond fire of Treasury yields, and finally, rapidly escalating global fissures in trade. Now, any one of these is a major market-moving event in total isolation, but all four happening at exactly the same time, that is genuinely historic.
It basically sets up what we can call the twin pillars of our upcoming market volatility. Imagine a heavyweight bout. In one corner, representing the tech litmus test, we have Nvidia's CEO Jensen Huang. The market desperately needs him to deliver a flawless, pure forward revenue outlook approaching $400 billion. In the other corner, at Jackson Hole, we have Fed Chair Kevin Warsh, who is actively fighting unchecked, sticky inflation that just refuses to drop below that 2% target. It's essentially a bare-knuckle brawl between the absolute necessity for unchecked AI spending and the stark reality of strict monetary discipline.
What's truly staggering here is the sheer scale of Nvidia's explosive trend. The stock is up an astounding 1,149% compared to the S&P 500's 85% over the last 4 years. They're staring down a massive $92.06 billion Q2 expectation. It is a totally parabolic rise that has practically anchored the entire market's hopes. I mean, entire indices have been carried on the back of this single relentless growth curve.
Yet, despite that record-breaking revenue, there's a really fascinating paradox developing just underneath the surface. The PHLX Semiconductor Index is actually down 18% since early July. Why? Well, because when a company reaches a $5.2 trillion valuation, the hurdle rate, the absolute minimum required to impress Wall Street, hits a physical and mathematical limit. Expectations are so sky-high at this point that even absolute perfection on an earnings call is barely enough to move the needle. For investors, this creates extreme vulnerability. Anything less than a total miracle is suddenly priced as a failure.
And this exuberance isn't happening in a vacuum. The sheer scale is staggering across the entire sector. We're looking at the hyperscalers, and by that I mean tech giants like Alphabet, Amazon, Microsoft, and Meta. They are expected to pour well over $1 trillion into data center capital expenditures next year. That's a trillion with a T. It's a massive, completely unprecedented financial commitment that is totally outrunning historical Wall Street estimates, fundamentally changing how capital is deployed across the tech sector.
Let's actually follow this capital down the funnel to see the true impact. First, the hyperscalers drive that $1 trillion in CapEx. Second, the infrastructure beneficiaries, the companies actually building the tech, they see massive 100% year-to-date returns. Third, the capital fragments into real-world data acquisition, like Reddit licensing its proprietary data over to Google. But here's the catch. This entire ecosystem generates massive upfront costs while heavily delaying the actual returns. It forces these tech giants toward negative free cash flow, which is a highly dangerous position if the macroeconomic environment suddenly tightens up.
But this massive AI train is hitting some serious, real-world roadblocks. An astonishing 71% of Americans now completely oppose local data centers being built in their municipalities. Let that sink in.
To put that completely wild statistic into perspective, public opposition to AI infrastructure is actually worse right now than the opposition to nuclear energy. Everyday people are heavily and vocally pushing back against the massive power grid strain and land requirements showing up right in their backyards.
Because of this escalating public relations crisis, tech giants are being forced to deploy major corporate mitigation tactics just to keep building. We're seeing OpenAI scramble for a massive 10-gigawatt power deal in Ohio just to secure enough electricity. We're also seeing companies having to navigate strict new executive orders, like those from Pennsylvania Governor Josh Shapiro. What we're witnessing here is a biological and political bottleneck that acts as an impassable physical limit on AI's endless growth narrative.
Meanwhile, as the tech sector spends heavily and fights for grid power, we have to shift our focus back to that macroeconomic anchor. Fed Chair Kevin Warsh is stepping into Jackson Hole as a harsh critic of over 5 years of above-target inflation. He is entirely retreating from the Powell era's reliance on forward guidance. He's looking right at the inflation elephant in the room, and he isn't blinking. The power dynamic is shifting directly from Silicon Valley CEOs right back to the Federal Reserve.
The market is absolutely demanding a concrete framework right now, and Warsh is utilizing a strict, three-pronged approach. First, he's aggressively analyzing the impact of government fiscal policy on baseline consumer prices. At the same time, he's actively hunting for isolated financial bubbles, keeping a microscope on that specific exuberance in the AI and tech sectors. And finally, he's returning to foundational money supply tracking to ensure baseline liquidity doesn't reignite inflation all over again.
This precise dynamic brings us to what the briefing calls the bonfire, and it is the tech trade's ultimate nemesis. Right now, 10-year Treasury yields are hitting 4.74%, and 30-year yields are surging to 5.28%. Look, when hyperscalers have to borrow massive sums of money to fund their $1 trillion AI buildouts, these surging borrowing costs actively threaten their highly sensitive profit margins. If you hold these major tech stocks in your portfolio, this yield curve is the exact metric you need to be watching every single morning.
Complicating Warsh's mandate even further are severe global exogenous shocks. We're looking at deep trade fractures, including a rapidly spiraling US and Canada trade war. Add in Asia's dragging 5-year property crisis centered in China and domestic executive interventions pushing Bitcoin near $80,000. These geopolitical landmines make suppressing domestic inflation while keeping the broader global economy stable an incredibly difficult, almost impossible tightrope walk for the central bank.
The briefing also analytically notes the political landscape, specifically around the proposed capital gains tax indexing. While it's often framed in the public sphere as middle-class relief ahead of elections, the source data tells a different story. It indicates that about 2/3 of all capital gains actually come from households earning over $1 million. So the institutional report characterizes this as a maneuver that deeply impacts institutional wealth and corporate asset allocation, rather than offering material relief to everyday retail investors.
So the crucial, overarching point of this entire briefing is this. What exactly happens when a $1 trillion AI buildout meets 5% interest rates? What is the mathematical outcome when an unstoppable, absolutely debt-hungry tech force slams headfirst into the immovable object of high macroeconomic borrowing costs?
Well, this intersection perfectly explains why the NASDAQ 100 has shifted so dramatically from a bull market leader to a current market laggard. The core insight here is that the AI boom and current macro policy are mathematically antagonistic. Hyperscalers absolutely must borrow massive sums to build their infrastructure, exactly as sticky inflation forces bond yields higher, making that very debt prohibitively expensive. The math simply no longer supports the aggressive growth models we've seen over the past 2 years.
To survive this brewing storm, institutions aren't just crossing their fingers and hoping for the best, they are actively utilizing what's known as the barbell strategy. It's about perfectly balancing short-term defense, like buying put options on the Russell 2000 to shield against sudden rate volatility, with medium-term offense, like buying call options on the NASDAQ 100 proxy. The goal is to carefully capture the final runaway AI bull market FOMO right before the checkered flag waves and reality actually sets in.
Now, for those of you with heavily AI-tilted portfolios who want a more structural approach, the solution outlined is building what they call a negative beta sleep well portfolio. Negative beta assets are fascinating. They actually tend to move inversely to the broader market. When tech and high-growth stocks take a sudden hit from rate shocks or earnings misses, these assets act as a critical ballast, basically keeping your financial ship steady through the turbulence.
By allocating to specific, highly resilient consumer and defense heavyweights, companies like ExxonMobil, Costco, Lockheed Martin, and McDonald's, you effectively hedge against immediate interest rate volatility. The brilliant beauty of this specific allocation strategy is that it provides a hardened defensive shield, all while allowing you to comfortably maintain your core exposure to the terminal upside of the AI revolution. And you get to do it without losing sleep over daily market swings.
As we watch the tech sector and macro policy inevitably violently collide in Q4, I want to leave you with this final critical question. Is your portfolio built only for a sunny day, or is it truly fortified for the 2026 storm? Take a close look at your own allocations today and ask yourself if you are genuinely prepared for this mathematically antagonistic market. Thanks for joining me on this explainer. Keep learning, stay focused, and I will see you next time.